Hello, hello. Welcome to the channel. We're about to get started in a couple minutes. I was supposed to get on like 10 minutes earlier. I failed to do that because I got stuck watching Joe Biden. He was talking about how the Republicans are having like basically a civil war within their own party. I don't think that's very true. I think he's talking about the fake Republicans that pretend to be Republicans that are actually Democrats, but that's a very small percent, and it's all rich people. It's all the rich Republicans trying to lead the poor ones, try to convince them to be politically correct. The poor people just don't know shit about being politically correct, and they ain't trying to know shit about it neither. That's what I know. A lot of fake Republicans. A lot of dumbass Republicans, too. I definitely identify closer to Republican than Democrat because all Democrats are just the worst of the worst. But Republicans can be pretty fucking bad. I know. I met a lot of Republicans that fucking love big government, and it's like, shut up, retard. Retard. Let's go. We're about to start, people. Let's go.
Alrighty, welcome everyone. So we're on our second AMA today. I'm JSmar18, but you can call me Jack for the rest of today's live stream. And I'm here with Dave Lauer, who has got some seriously impressive and wide-reaching knowledge. So let's welcome Dave to the stream.
This is a different guy than the guy we had the first time. Interesting. I didn't realize multiple people had access to this stream. That's very interesting.
Hi.
Thanks for joining us, Dave. So first off, we'll be covering a really wide range of topics based on some of the questions that all the subreddit have submitted. So we're touching on everything from high frequency trading over to dark pools, even payment for order flow, and a bit more as well. So it'll be a action-packed hour for everyone that's watching. So grab a cup of tea, settle yourself in, and we'll get going. So Dave, let's just start off, and for people who haven't know your experience, could you just give us a bit of a rundown on what your history is with the U.S. financial markets and just some of your career history as well?
Sure, Jack. Thanks, and thanks everyone for tuning in. It's very exciting that there's interest and attention in this space where there usually isn't that much. My career was really primarily sort of technology focused. I worked at a startup in New York building extremely high performance data routing systems called middleware systems. And it turned out at the time, which was around 2005 to 2009, the firms that were most interested in that kind of technology were these firms called high frequency trading firms, and not many people had heard of them. And it was also a pretty interesting time of transition for US markets as Reg NMS was adopted and then implemented. So after doing that for a few years, I saw what was going on the HFT side of things and said, geez, these guys are making a lot of money. I got the opportunity to join one of those firms. You might have heard of them before, this small firm in Chicago called Citadel. And a friend of mine was going there to start a new trading desk and asked me to come with. And so I did. And so I moved from New York to Chicago with my wife and spent less than a year at Citadel. And
So he's not coming off as a bad guy. Like, he seems like he just knows a lot about what's going on, and he stepped into it but didn't live in it.
Without getting into the details, as a trading desk, we left and we went to another HFT firm called Alston Trading, nice. Which was actually a smaller firm. And I worked there for almost 2 years. And then I left, I think, as I'd mentioned before, in 2011, which was a year after the flash crash, after trying to get involved in making markets better and, not really succeeding. So I had really intended on leaving finance at that point, about now almost exactly 10 years ago, because I didn't like the industry. And so I built...
That's fair. He realized he was part of a problem and stepped away. Like, this guy's coming off as a totally legit dude.
A storytelling website called cowbird.com, like the two animals, which is still online, with a friend of mine. And on the site, I told the story of why I left high frequency trading. And someone from NPR heard it and asked me to come on this program called Marketplace. So I did that, and it was pretty cool. And suddenly people were really interested in talking to me, like the Senate and the SEC and some guys in New York who were starting a new stock exchange. So I kind of got sucked back in through no real intention on my part. But I found that I could do things on the other side and maybe help institutions with better exchange design or better regulation and legislative design. And then I started also working for asset managers. So for the last 10 years, until about 2 years ago, I really just consulted and worked on my own. I worked with IEX in the earliest days when the exchange was being designed and built as an ATS. I worked doing quantitative analysis for asset managers, looking at how their brokers were using order routing algorithms to navigate this incredibly complex market structure. I learned of the term market structure, which I hadn't known before, which was apparently what I knew, which is a very niche like space to study. And so that, I've...
There's some parts of the market structure I understand better than this guy, and there's lots of parts he understands better than me. But everything this guy knows, I will know one day.
Sort of seen all sorts of different parts of the market ecosystem, from high frequency to exchanges to large broker dealers to institutional asset managers, helping them with best execution. I've learned a lot about retail and how that pipeline works. And I've worked with regulators and Congress to help them understand better how modern electronic markets work.
It's so weird to me that someone like him can have so much knowledge and not just go make the, like, did he sign a contract saying he's not allowed to make $100 billion? Like, I just don't I understand you need, I guess everybody's trades now is all about making 1% for a month or something. Like, I guess the scalping is very, very small. I don't know. I just feel like on his own, he should be able to make so much money.
And then for the last couple of years, I've really focused on artificial intelligence, which was more of an interest of mine, and really not specifically in finance, but sometimes.
Okay, that's interesting. I find it funny that you mentioned that you left mainly based on the ethical reason. What actually about that? What about your ethics actually made you decide to leave after the flash crash?
That's the wrong question. What about your ethics made you feel like you were doing something wrong? What were you doing that you were like, no, I shouldn't be doing this? Were you shorting the stock too much? Did you know you were breaking the law? Like, don't fucking tell us. Don't talk about your ethics. We don't care why you did it. Tell us, what's really going on.
Crash incident.
Well, I think,
so personal. Who cares?
I went into high frequency with maybe a naive or romantic notion of, this is how you can make markets work. This is the lubricant on the gears of capitalism, right? This is, if you're a believer in capitalism, which I was, and to a certain extent still am, and you believe in that type of philosophy, then, it was a rather somewhat of a noble pursuit that was also very lucrative. So, it worked really well in that way. But the flash crash kind of opened my eyes to this idea that maybe the speed of technology and the incentives in the markets were making things a bit more fragile rather than stable and resilient. It seemed like things work really well when they work well, but when they're put under stress, they really fall apart. And so I found that kind of disturbing. And so after the flash crash, a little bit after, the CEO of the firm came out and he asked for anyone who had any ideas in terms of like new regulations or new thoughts on markets. He said, we're going to be getting involved and you're going to have to lobby and do this. So, let me know if you have any ideas. And I went to him with like this whole this whole thing. I wrote up that here are the things that I think should change about markets. And even though it might affect our profitability in the short term, in the long run, it's best for markets and therefore, best for the firm. And he literally laughed me out of his office. It's not a joke. And so, I think that was when I realized it just wasn't for me.
They only care about making more money.
That's really interesting.
They don't want to know
and
nothing.
You've noted that you've spent some time, or you're currently actually on FINRA's Market Regulation Committee. Is that right?
Yeah, that's right. Yeah.
So I'm interested in, we know a bit about the SEC, and they've been pretty tight-lipped in regards to the GME incident, along other meme stocks. But what kind of role does that committee actually play in an advisory capacity for the market?
Yeah, so it is an advisory committee. It's not like it has any actual authority per se. It does. There are some things that have to go through the committee before they can be proposed for public rulemaking. But it's just an opportunity to be in front of the people at FINRA who are policing markets, who regulate markets, and who deal with enforcement, who are studying markets.
Oh man, this is not nearly as good as the last one. Like, why are they so worried about him? Tell me about what I want to know. Like, I enjoyed the beginning where we got to know that he was somebody legit, but like we're way past that point. Let's get to the nitty gritty. Holy moly!
Markets, and I like it as an experience. I think it's quite fascinating, and the way the committee is structured, there are industry members who are broker dealers. So FINRA is an organization that is funded by the broker dealers and it regulates broker dealers. That's all FINRA does. FINRA does not regulate asset managers or anyone else, just the broker dealers. And so you have industry members and then non-industry, and I'm considered non-industry or independent. We meet I think 3 times a year, and generally we talk about new potential rulemaking, concerns from the FINRA staff that they want to get our opinion on, and if there's things happening, you can be sure that those things will come up. It's confidential what happens at the committee.
So basically what this guy's in charge of is the rules for all the people selling 401ks, IRAs, anyone that's a broker-dealer, E-Trades, life insurance companies, anybody out there that's like positioning themselves as a business of finance. They got to go through FINRA, and these guys basically get a look at any laws that are getting looked to be passed, and they get to stress test all the laws and then say, we approve, and now the government gets to vote and make it law. But FINRA has to approve it before that happens. So any bad law out there is because we didn't have good enough people in FINRA to see the problem before it came.
So I can't talk sort of specifically to that, but it's the last couple of meetings have been pretty interesting. And I am not one who holds back or is even guarded about what I say, because I don't care. Like, it doesn't really affect me. I don't make or lose money in any way from anything that happens in there. So I usually just tell them what I'm thinking, and you can see that there are other members of the committee. The industry members are broker dealers that whose names you would recognize, and they generally feel very differently from me, and it can lead to some good conversation.
Yeah, no surprise there. So one of the actual purposes of the committee is advising on the short sales as well as trading practices. And it might not be your area of expertise, but I think we'd be interested as as a community to understand what was your actual view, like maybe your personal view of the GME situation as a whole when it took off in late January.
Yeah, Jack, like I was saying to you just earlier.
So basically, he just asked what was his view on the shorting practices of GME throughout this whole event since January. That's all he asked just now.
Earlier, I actually went on TV on BBC to talk about the GameStop situation, which was the first time I'd been on live TV and the first time I'd been on TV in quite a while. And if I'm on TV, things are going weird or wrong. It's not like people call me up when things are going well. And so, GameStop has been fascinating from the perspective of the sort of traditional parts of the industry, which I tend to be tapped into. I talk to lots of asset managers. I talk to brokers. I talk to other market structure experts and aficionados. And so it's been really incredible to see. At first it seemed like it was just some kind of crazy retail blip, but I think over the last more than a year, since the pandemic started, we've really started to see the structural change in markets with increased retail participation, which I think in many ways is a very good thing. But in some ways, I'm very concerned. I'm very concerned about the way that these apps are structured and the way that they incentivize over trading. I think that's a big problem. I think people who have not seen a market crash have no sort of understanding of what that can be like. And I'm not trying to comment in any way on what the value of GameStop is. I have no idea. And if I had thought I did, I've been proven wrong time and again. So that's not what I'm what I know. I'm not a fundamental analyst or even a technical analyst or anything like that. But in terms of like the way that the markets have handled it, it's been very interesting to see some of the changes that have taken place. I do think what you mentioned short selling, and I think that short selling is a huge concern in markets. Now that's not just, I believe in short selling. Shorting is really important for.
All right. Well, it sounds like we're about to have a real conversation right now. Let's see what he's got to say. Sounds like we're about to talk about something that actually matters.
Well-functioning markets. But predatory short selling or naked shorting is a huge concern. One thing I didn't mention in my intro, but I've been doing some analysis of market manipulation using public market data. And there's no doubt that we see really significant manipulation in different stocks at different times. And I can't get into detail, but some of the theorized reasons behind it are definitely around naked shorting, or the idea that shares are being rehypothecated over and over again, lent out to create far more available.
That's what my whole petition stops. If we recall the stock, all the rehypothecation comes up to the table.
Shares in the market than the actual float, which is why you can see numbers where you have more than 100% short interest in certain names. I'm very concerned about failed to delivers and ways of manipulating failed to deliver statistics.
Ooh, how many of the numbers they say are real stocks are actually synthetic stocks?
I think that there is something to some of the posts that I've seen on Reddit that have looked at the options market and tried to understand whether that is a way of covering up fails. And it's actually an analysis I'm very interested in and might look into myself, because I really do think that these are concerns that regulators care about as well. I don't want to make it out that regulators are just not paying any attention, but it can often be overwhelming when you look at the level of technology and data and complexity to try and regulate these kinds of markets.
I mean, It's not that overwhelming if you understand all of it, and like he acts like he does. I guarantee you, bring me in there. There's no question they can't. There's no question they can ask that I couldn't take a team of data scientists and find the solution to. Zero questions you could ask that I couldn't find the answer to.
Yeah, that's interesting. And at least from my perspective, it feels like the SEC, from a regulatory perspective, has been moving kind of slow in the past decade when it comes to their response to, high frequency trading or dark pools, or they have a lag in terms of when something comes to be popular and when they take action into it. And, the influx of retail in, 2020 during the pandemic is a big sign, and then an even larger influx in the beginning of 2021. Do you think the SEC are actually, were they ready for this to happen? And, could we expect any, material changes in the future to actually in response to retail to help, put us on an equal platform of sorts?
I don't think anyone expected this shift in retail. I sit on a stock exchange board in Canada. We've looked at these, we've seen very similar things happen in Canada, but in Canada, retail order flow is on exchange. So that's a big difference between Canada and the US. In the US, though, even though retail has exploded, that volume has stayed off exchange. And so, was the SEC ready? I don't think so. And they don't move quick. If there's anything that I can tell you, it doesn't mean that they're being incompetent or deliberately dragging their feet. They're a government regulator, and they move extremely slowly. And it's been extremely frustrating for me. When 9 years ago, I testified before Congress, and I set out what I thought were extremely non-controversial ideas for improving markets and increasing transparency, and I presented them to the SEC that same year. And most of them didn't get done, and one of them it took like 6 or 7 years to get in place. Stuff that nobody would really have disagreed with in terms of transparency. So it's just the nature of things. It's very frustrating. But I think that
not in my world.
There are some promising signs. Gary Gensler coming in as chair of the SEC is promising. He seems to be enforcement minded. We'll have to see. We've sort of been here before. And the level of popular attention is incredibly important. And if there's, there are some things that people can take away from this, how can you make a difference or get involved? If you keep the attention on these issues and you keep the SEC aware of your interest and you keep your members of Congress aware of your interest, that's the kind of thing that could make them move quicker. And, they do respond when there's attention on issues, and especially popular attention.
All right, good to know. Let's move on to one of the more popular topics which we talk about, and it's high frequency trading. So back in 2012, in a statement to the SEC Roundtable on Technology, you basically stated that technology hasn't moved so quickly technology has moved so quickly that most market participants have not been able to keep up. Moving into 2021, do you still have that same perception, or has it changed?
Oh yeah, I think so. I mean, I think even more so. I mean, I don't think most people understand what the impact of technology on markets has been. It has increased complexity dramatically because I think you have rules and regulations that were for a different era. And most of the current rules and regulations were really set up before electronic trading was as pervasive as it is today. So, I think that regulators have really struggled to keep up. And I think that even when they've been able to get on top of issues, they've generally done it from a very sort of simplistic perspective, a very linear way of thinking. And I think one of the things that when you're regulating complex systems and complex markets, you need to understand complexity theory and nonlinear theory, and that's not something that regulators understand. And so, you often see attempts at top-down regulation versus sort of trying to shift incentives bottom up and then let the market kind of play out. So I think the current way that retail trading works, which is that it all goes to a wholesaler such as Citadel or Virtu, and that all of that volume is internalized, is an example of something that existed before technology and probably made sense at that point. But technology has moved along so much that still having that system in place doesn't make nearly as much sense at this point. And because of that, I think it's leading to worse outcomes for the entire market by keeping that kind of volume off exchange.
Yeah, that's interesting. I think one of the important topics I was thinking about was volatility as a whole, and how high frequency trading has kind of contributed to that. So the SEC, they recognize that since the mid 2000s, we've witnessed average trade sizes drop, the markets have fragmented further, and this is all accompanied by a rise in volatility. So from 2010 to 2013, it was 40% higher in terms of volatility compared to 2004 and 6. And that pretty easily correlates with the increase in high frequency trading. So my question is, on the volatility front, does high frequency trading promote that volatility, and how does it actually promote that volatility?
So I've seen some interesting studies that, and you can often find studies that go both ways. So you will find people that can cite studies that show that it has not increased volatility, and you can kind of find the other side. And often that can depend on your how you define volatility, first of all. I think that high frequency trading in many ways can exacerbate extreme moves. I think that you have, here, I'll show one slide. I've got some things that from time to time might make sense for me to show. And so let me throw this one up. So here with this is sort of a history of high frequency trading, and it focuses on what are called illiquidity contagions or flash crashes. And I don't, maybe we can zoom in here, but you can see that these are.
So far, they have not talked about a lot of, he talked about he thinks the OTC is bad for the market. He talked about he doesn't really like shorting too much, but he thinks it's important, but not naked shorting. Yawn. Now he's talking about a flash crash and why high frequency trading, basically, everyone had the same algos, and the algos all saw the same problem, and the problem told them to take their money off the table. When everybody takes their money off the table at the same time, the prices get crushed. It crushes everybody else, then the rich people buy it back in when it's real cheap, and they make all the money. Surprise, surprise, the flash crash makes the rich richer. Surprise, a motherfucking Surprise.
4 sort of dramatic events. There was the pound or the cable crash here, the Treasury yield crash in October I think of 2015, and then the flash crash obviously here of 2010, and then another a euro response, and you see these in certain isolated incidents throughout the years, but then you see them happening to individual names even more frequently. And when we talk about our regulators up to the challenge, the response to the flash crash and to other sort of these illiquidity contagions was to institute limit up, limit down rules similar to the futures market. And my concern with that has always been that that's more of like a Band-Aid. You're treating the symptom rather than the cause. And these things get a little complex, but there's a lot going on when you think of the way that markets function and the way that markets have evolved to need or to incentivize high-speed trading and to really create this race to zero latency. And so as latency requirements and competition over latency has increased over the last for a long time, but in terms of high frequency trading, really since like 2005, which was actually when I kind of started in the industry.
Holy shit, this is boring. Holy shit, I do not care about high frequency trading. The high frequency trading is so simple, people. If people come in and buy a shit ton of stock in a stock they don't want to go up, then their computers tell them to throw a shit ton more on the market to sell, so that the price doesn't go up because there's more liquidity to sell on the stock. And so every time, like, who fucking cares about the fucking scalping of the back and forth when it goes up and down, up and down? Like, we know they're doing that. We don't care.
Not taking any blame for that.
Give us some facts.
What has happened is that when you only have like 10 microseconds for your software to make a decision on whether it wants to place an order in the market,
then it doesn't concern us. If you only got 10 microseconds to do it, then we'll never be able to do it. So don't consider yourself lucky enough because you got to live a mile away from the exchange. So just give up on life. Why the fuck are you talking about 10 milliseconds right now, you fucking retard?
Cancel an order in the market. You don't have a lot of time for complex logic or even potentially for risk checks. So what happens is the markets and the trading strategies that are profitable start to look more and more like each other. It's called self-similarity. And when that happens, you crowd out other trading strategies. And that's part of the problem as well with off-exchange trading is when trading happens in an internalization system or in a dark pool, it has to trade between the national best bid and offer. So someone had asked on the one of the threads, what's the national best bid and offer? So if you can put this slide up, this is just a quick diagram that shows that you have quotes in the market. Here we've got NYSE, NASDAQ, BATS, and EDGE, and each of them has different bids and offers. And so the Securities Information Processor is the market data system for the industry, and it aggregates all that up. And it says, well, the best bids on EDGE and the best offers on NYSE. So the NBBO is 02 by 05 here. And that's the SIP is the public data feed. Exchanges also have private data feeds that are faster, that show more information, and that high frequency firms all consume. And without getting into those issues, what happens here is there is lit exchanges. The NYSE, NASDAQ, BATS, IEX, these are lit exchanges. And that's what a market is. That's where you get price discovery. What's something worth? And what something is worth is important to a company because that's where they can raise money at. So valuations mean something and they're important, right? And that's what public markets are supposed to do, figure out what something is worth. And so when you have these lit exchanges providing a mechanism for price discovery, but then in dark pools and off-exchange trading, you're trading within the NBBO, you are free riding off that lit quote and you're taking advantage of it. In Canada, in the UK, in Australia, this kind of setup where trades go to someone like Citadel or Virtu is illegal. They don't allow it to happen because...
That's good information. Good to know we're suing for something that already has precedence.
It can damage the lit market. It can disincentivize market makers. And that's in fact what I think we're seeing is you're seeing market makers that are disincentivized to post orders or post aggressive orders because they know if I post the best bid, well then Citadel or Virtu is just going to execute an order based off of my price and I'm not going to get to see it. So why should I improve the bid, right? So that pushes people out of markets and it incentivizes speed or it incentivizes having captive order flow like Citadel or Virtu have when they get all of this retail order flow. So I think it's very problematic, and it leads to this self-similarity. And that does make markets more fragile because we incentivize speed and we incentivize captive order flow. And it leads to exchanges being the very last destination. So here's another example where this is what markets look like. And it's nothing like what people have traditionally thought markets look like, right? And what you can imagine that when a broker-dealer gets an order, they're going to be sending that order to all of these dark pools and all of these different places. And the last place they send that order is to an exchange, because the exchanges end up being the most expensive and the fewest orders get there. So they end up being what are called toxic venues or toxic exhaust venues, or what our exchanges have turned into. And so that is very problematic because it means that the price discovery mechanism, which is one of two reasons why markets exist. They exist for price discovery and they exist for capital formation. And it means that we've really messed up the price discovery mechanism.
Yeah, you touched on an interesting point. So you say it's expensive to actually go direct to the exchange relative to going to a dark pool. Wouldn't it be in say the NYSE's best interest to actually incentivize going directly to their exchange instead of being routed through a dark pool?
It would. If the NYSE wasn't wrapped up in a prisoner's dilemma. So to get briefly into game theory, basically there is a regulation in U.S. markets. It's called the access fee cap, and it says that you cannot charge someone more than 30 mils per share to buy or sell something on an exchange. 30 mils per share means 30 cents per 100 shares. So that is a regulatorily imposed access fee cap. It's essentially regulatory price.
Who cares about the fee to buy a share? Like another nothing talking point.
And it was put in place when Reg NMS was put in place, which was designed over a long time, but finally passed in 2005 and adopted or implemented in 2007. And it was basically, we see INET charging 30 cents per 100, so that's going to be the new cap. And it has not been adjusted since then. And so what that has led to is it has led to every exchange competing over rebates. So they want to pay people, other firms, as much as they can to rest orders on the exchange, to post orders on the exchange. And so they'll get very close to that access fee cap with their rebates, which means that the access fees that they charge for liquidity taking orders, so you receive a rebate on most exchanges, you receive a rebate if you post an order, and you pay a fee if you take liquidity.
I just got an alert saying that E-Trade now allows me to buy Bitcoin. How pathetic. GME's down 0.5%, AMC's down 2.5%, 916 for AMC, 159.93 for GME. Nasdaq just went red. Dow is a little bit green. S&P's basically broke even right now. And everything's basically bleeding again today. Everything. NBIS is getting wrecked today.
And so every major exchange charges 30 mils, 30 cents per 100. Now, as I think Reddit has learned, IEX is not one of those. IEX is what it's called a take venue, 8 cents per 100 shares on either side. Whereas NYSE, Nasdaq, BATS, the big market share exchanges are maker taker, which is where you get paid a rebate to provide liquidity and you get charged a fee to take liquidity. And so because of that, the exchanges have struggled to reduce costs, because if they reduce the fees that they charge, they also have to reduce the rebates that they pay.
I don't see how this information pertains to the problems that we're having now. Like, I understand that they're all fighting for every dollar and it's causing problems, but let's stick to the real problems that we're facing with GME and AMC.
And as long as another exchange is willing to pay a very high rebate and keep their access fee cap higher, or keep their access fee up at the cap, then it's a prisoner's dilemma. And this has been this is not like a controversial thing. Everyone has recognized this problem. And there have been attempts to implement a pilot, for example, the trading fee or the access fee pilot, which then the exchanges turn around and they...
We just need to cut the human out of the trading process. Every single aspect of the trading process needs to become like the blockchain, and it's all self-implemented, and nobody gets a profit off the top. That's as simple as it is. If you want a profit to go somewhere, then it can go to a flat tax to the government. That's the only,
challenge in court. So they have actually sued the SEC for trying to change this because the SEC wasn't going to apply it to payment for order flow. All of these issues are completely entangled, right? It's a complex system, and you can't simply pull on a string in one part of the system without understanding that there are going to be unintended consequences that ripple through the rest of the system.
Yeah, an example of, say, the rebate side of things. So the NYSE has a program called the Supplemental Liquidity Providers. Is that what you're talking about?
Yeah, that's right. Exactly. Yeah.
Interesting. All right, we'll move on to some, more of the manipulative practices that, high frequency trading is associated with. So in the early days of, the GME saga, post-January squeeze, there was a lot of talk about what Reddit describes as short ladder attacks, which is essentially our way of describing our stock's price being manipulated down slowly with low volume to essentially mimic organic price movement. And we came to this conclusion through observing the level 2 order book data of some really bizarre lot trade, lots being traded back and forth at odd bid-ask prices. So to me, this sounds eerily similar to wash trading. And I know it's illegal, but is it still possible to actually and is it feasible, from your perspective, that these methods still exist and are being used to actively manipulate markets?
Yes, without a doubt. And it is unfortunate. Like I told you before,
yes,
I've been starting to look at
this
at market data. What you call level 2 book. If you look at, you can get historical depth of book market data, which is every single order, trade, order modification in the market. And you can use that. I've used it to work with institutional asset managers to help them understand what their transaction costs are, for example. But recently we've started to look at it and look for market manipulation, and it's there. It's
everywhere,
sort of shockingly
everywhere,
rampant. I can't say a ton about that, but what I have seen is not good. It's surprising because regulators are supposed to be looking for this kind of thing, but their systems are they struggle with the amount of data, the complexity of the data, the timestamp issues. These have all been issues for a while. FINRA has gotten better and better, and I think that if it's taking place and it's obvious, like you've described it, they'll find it. You tend not to see the repercussions of it, right? Like it's not always an action that gets publicized. It can often be, just a fine that gets lumped in with other fines because those same firms did a bunch of other things. We
want more than a fine. They're making too much money.
I think that spoofing and layering in markets is a big problem. And I can say that just from the experience of constantly looking at market data for those patterns and seeing them relatively regularly.
Yeah, could you just expand on spoofing and layering for those that don't understand what those are?
Sure. So you were talking about looking at the level 2 order book, which is you have, as I explained before, you have the best bid and the best offer. The bid is the highest price someone's willing to pay for something. The best offer is the lowest price someone's willing to sell it for, and that's the spread between the bid and offer that trades will happen in. But above that offer, you can have at each price level a certain amount of volume that someone is willing to transact. So as that price gets higher, you can imagine more and more people are willing to sell. As the price gets lower, more and more people are willing to buy. And so that's what makes an order book. And so what spoofing is okay, so you can know that the way a high frequency trading system is calculating a micro price, for example, which is the attempt, if the high frequency system says, okay, I think that GameStop is worth $180 right now, and it's being bid at 179 spot 80. So I can say, well, I'm going to improve that bid, right? I think it's worth 180. So I'm going to I'm going to put a bid out there at 179 spot 85 because I want people to sell it to me. I want to buy because I think it's going to go up to 180. And I think it's going to happen very quickly. So, I'm only going to have to hold that inventory for a few minutes before it ticks up a couple ticks. And as it does, I'm going to have my offers in there at 180. And so as it ticks up, it's just going to lay off into that. And I'm going to end up flat because most HFT systems want to be flat. They do not want to take on inventory. They are operating over very tight time horizons, milliseconds, seconds,
so when they see someone
maybe
place a
minutes,
big
but that's
order,
a very
they come in and
long
place
time.
a big order right below you,
now,
and they sell
if
it to you for
I
a half
know
of a
that,
percent.
okay, that's how an HFT
Holy
system
shit,
works, and I know it
people.
calculates.
When they see your order on the market, they come in and they buy it knowing it's going to trigger your thing, and they right in return sell it right back to you. Holy fucking
its 180
shit.
micro price
That's awesome.
Because it looks at all the bids in the market and it sees there are a lot more bids than offers. So I can put some bids in there that are not at the best bid. So I don't have as much risk of being executed on these orders, but I can put a huge number of shares, a couple price levels down, and create the appearance of demand. And that's going to make these automated systems think there's demand and they're going to move up. But what I'm really trying to do is actually sell. So I'm trying to push the price up into my sell orders as a manipulator or a spoofer. So that's what spoofing is. Layering is relatively similar.
Okay, and correct me if I'm wrong, but those mechanics are basically some of the reasons for the flash crashes that we've seen in recent history.
Yeah, I mean, I know that the reports that come out have talked about some of these manipulative practices being responsible for some of flash crashes. That's not something that I sign on to. I'm more of the belief that these are complex systems, and it's kind of a fallacy to assign a broken part. And so when a plane crashes and they say, oh, this part of the wing failed, that's why the plane crashed, right? So in the flash crash, they said, oh, this guy was spoofing markets, and that's why the market crashed. But that's not how nonlinear systems work. That's how linear systems work. A causes B causes C. But in nonlinear systems, that's not how it works. It's an emergent property of a self-organized system. I mean, I
was ragging on him a little bit. Honestly, this was a good interview. Like, there was only a couple gems that he landed on us, but I did hear a couple gems in here, and I'm glad that we watched it, and I'm glad we listened. I don't know that we're gonna get anything more out of this. I feel like they're winding down right now, but I'm satisfied. It was pretty good. You
can go down a rat hole with this kind of systems theory and complexity theory, and I've written a bit about it. But I think that assigning that sort of A causes B is not correct, because you can have the exact same conditions happen another time and you won't have a flash crash, because that's how nonlinear systems work. You can't quite explain it in the same sort of framework that we're used to. It's there's the reason that the spoofing had that effect was because of years of regulation that have removed diversity from the markets and led to a latency race, and that have fragmented markets across multiple exchanges. And it's sort of environmental and regulatory and legislative, and then there's also potentially a precipitating event, which is someone spoofing, but that's not necessarily the cause.
Yeah, I find it interesting because on several occasions with the GME, we've seen similar events that could be described as as a flash crash, for better or for worse. So one that happened in March happened within 30 minutes. So we had GME drop from 345 to 173, with almost 72,000, all within a 30-minute gap. And we also saw gap downs in price, and all of these are very, what I perceive as reflective of HFT, essentially manipulating the price. So,
and it doesn't have to be manipulative. When we think of illiquidity contagions or flash crashes or like the things you've described, sometimes it's just them pulling out. Right, so if 90% of the quotes in the market are from HFT firms, sometimes as high as 99%, and suddenly the volatility increases, or they take on too much inventory and they need to stop trading, which is a lot of what happened during the flash crash proper in 2010. They'll just stop quoting, and as soon as they they stop quoting, suddenly, that liquidity just starts disappearing, and other systems key on that, and then they start pulling out, and it, it's this positive feedback loop. So I mean, maybe, I'm not dismissing the possibility of manipulation, because I see manipulation in markets, but sometimes it's also just sort of a this feedback loop that gets away from itself.
Interesting. Let's touch on order types. So personally, I've read a bit about order types before and basic market structure, and the Wall Street Code, which was a documentary that you were part of that you mentioned earlier, started to peel back some of these layers in regards to order types, and HFT traders getting certain advantages over others. And I'm particularly interested in the conflict of interest between exchanges and non-retail side, and how there isn't any equality there. So why not provide retail with the exact same options as they do non-retail? Can I get your thoughts on that?
So if you want to put this slide up, I've thrown up an illustration from 2015 of the various order types that were available at NYSE Arca, NASDAQ, and BATS. So you can see kind of how crazy this is, right? When I said on the Reddit it's not, limited market, I was actually trying hard to post this picture, but I couldn't get it to work in the comments I see now. But, like here's an add liquidity only midpoint passive liquidity. You've got an intermarket sweep post no preference. Here's a display limit attributable non-ISO. I mean, it's like, intermarket sweep post no preference immediate or cancel. I mean, these are very complex order types. Most of them, or many of them, are often dictated by the biggest customers of the exchanges, which are those HFT firms. And it's not just retail that doesn't make use of them. Often, large broker dealers trading for institutional firms don't make use of them the way they should. And that has started to change. But I don't know how you would make. Do you know what an add liquidity only post no preference blind order would do? Because not even NASDAQ knew what it would do. NASDAQ got fined because they had some crazy complex order type that was messing with the priority in a way that they had not even imagined. And that was discovered. I think actually they found it and then self-reported. But it's like that's how complex things have gotten. So yes, the order types do advantage certain firms, and there's no way around it. Part of that is again because of regulatory conditions like Reg NMS, which has forced the exchanges to connect to each other and to provide functionality to route to each other, or to bypass that routing with these ISO or intermarket sweep orders, because Reg NMS said that if there's a price in the market on a protected quote that is better than the one on the exchange you're sending the order to, you have to go take that price on the other exchange. It's led to a huge amount of complexity, and so I think things would be a bit better if the market were simplified. I think the markets would be better with fewer exchanges.
Yep. Cut out the people. We don't need nobody profiting off the top of everything inside the market. We're done with that. It's all computer. It just needs to be first come, first serve. No, like nothing off the top. That's how it needs to be.
Non-complex order types. I don't know that much of this complexity is as beneficial as the costs of the complexity, but you'll never get access to that from most retail brokers, because most retail brokers are not sending orders to exchanges. Sometimes they will send limit orders to exchanges, but they'll send it generally to whatever exchange will pay them the highest rebate. And so you need to use a broker who would provide access to these kinds of order types. So the only one I'm familiar with that does is Interactive Brokers, versus some of the other retail brokerage platforms. And I haven't used like a ton of the active trader platforms on the other discount brokers. So maybe they do and maybe they don't. But many of them, for example, won't even route to IEX if you ask them to. Which if you're posted on IEX with a delimit order or a delimit midpoint peg, you're getting similar functionality to what HFTs get, and you're generally going to get a midpoint execution, which is better price improvement than any other retail broker will offer.
That's the most valuable piece of advice you've heard your entire life. If you're going to become a trader, if you could trade at the midpoint every single time, you just became a fucking hedge fund. It's so easy to scalp money if you get to trade at the midpoint instead of the fucking ask and bid prices every time. If you get to trade at the midpoint, like sometimes you get to trade at the midpoint and you like it when you do, but it's hard to wait for it. It's hard, like you hate that you don't know if you're going to be able to cash out at the midpoint later. But he's basically saying by accessing the IEX or whatever, you're basically guaranteed to fill at the midpoint. Fuck, that's amazing.
But of course, I am biased. I helped.
Amazing.
I worked with the guys at IEX. I know them. I have equity in it. So it's. But I did so because I believed in it. I thought it was a good solution.
It's a great solution. It's fucking amazing.
That's a good transition into payment for order flow side of things. So it's no secret that, Robinhood has kind of been popularized in this space, especially given their disclosures to customers last year, getting fined 65 million or so. But could you actually help us understand what are some of the negatives that come out of that from the retail side, and then also the impact on the market as a whole due to payment for order flow and that internalization?
So let me show you a couple quotes here. I don't like the idea that you pay people to trade. I don't think it should be done. I don't think it should be legal. It puts wrong incentives in the market. That's the CEO of ICE, the company that owns the New York Stock Exchange. Citadel Group urges the commission to ban payment for order flow. This practice distorts order routing decisions, is anti-competitive, creates an obvious and substantial conflict of interest between broker-dealers and their customers. We don't believe that a broker-dealer that accepts payment for order flow can consistently fulfill its best execution obligations. That's from Citadel.
What?
So,
ironic.
Ironically,
quite.
sure.
These were obviously statements made before Citadel engaged in payment for order flow, or before Jeff Sprecher, I think, owned the NYSE.
That makes a lot of sense right there. They went dark side, people. The market used to be probably kind of legit, and now they gone full dark side. Democrats took over everything, full dark side. The establishment owns the whole world right now, and are we going to win the battle? Are we going to win the battle?
That was more recent that he bought it, but I think that payment for order flow and the internalization of retail orders is terrible for markets. And I think that when the thing about retail order flow is it's referred to as uninformed, and that doesn't mean that you don't know where GME is going to go in 6 months or a year. You might have the best fundamental analysis in a long time horizon, but that's you.
Everybody, I think tomorrow's going to be another red day for AMC and GME. I don't see the trampoline bounce. I'm waiting for a trampoline bounce. I don't see it yet.
We're not informed about what is going to happen in the next 50 milliseconds. That's what, when you think of uninformed order flow, it means what is about to happen in the market as far as a high-frequency trading firm is concerned. And that time horizon is measured in milliseconds, maybe seconds. And so because of that, retail order flow is what market makers want to trade against. It's very profitable to trade against it. And so that's why these market makers pay the retail brokers for it, because they want to get that order flow.
Of course.
An interesting paper just came out that showed that the impact on markets is significant. That when you take that profitable order flow and you don't let it get to exchanges and interact with other orders on exchange, you can be affecting the spread by as much as 25%, maybe more. But at least what they could quantify, they saw that spreads would tighten by 25% if that order flow made it to markets, and then everyone benefits. So we think, and I know Reddit here thinks retail is active day traders trading through a discount broker, but I usually like to say that in fact retail is the wealth of the nation or the wealth of the world. It is mostly concentrated in mutual funds and pension plans. So you might have a small a trading account that you're playing with, but your retirement. Some people, I know some of you have it locked up in GME, but for some people, it's in a mutual fund, in an IRA or something, or a 401k like that. And to me, those are the funds that should have access to trade against retail orders on exchange, like the rest of the world does. And so I think that this is an area that's going to get a lot of attention.
I wish they would have asked them about recalling a stock in KIBO.
Some bills are being unveiled in Congress that could completely change this, and I very much support. And I think that I am in favor of competition. So, like I said, there are many times where I am a capitalist. I believe in intelligent capitalism and well-regulated capitalism, but capitalism nonetheless. And so I believe in open competition for order flow. Get the orders on exchange and let hundreds of market makers should be able to compete over that order flow, not just Citadel or Virtu. Now, along the lines of internalization and dark pools, I know that has been an area of a lot of questions on Reddit. So this morning, actually, I put a couple of charts together that I wanted to show. So just to divert briefly, I want to talk about dark pools versus internalizers. These are two different things. And you can see, FINRA has an excellent website, the OTC Transparency website. And you can see on the website, ATS, which are alternative trading systems, those are dark pools, versus OTC, over the counter, those are the internalizers. So here is GME in last November, it got cut off here, but it was 89% was trading OTC. So this is of the off-exchange volume. So a certain percentage is getting executed on exchange and a certain percentage is getting executed off exchange. Of the off-exchange volume, 89% of it in November was OTC. Think Citadel and Virtu.
Okay.
Versus March, 87%. So not much has changed since 2020. Most GME volume is getting executed through retail channels and is being executed on the OTC markets. So when you think dark pools, the thing about and where the confusion might lie is when a trade executes off exchange, either OTC or in the ATS, it is still printed to the tape, to what's called the trade reporting facility. And I think I have up here, you can see these are the market share generally in the market of the lit exchanges. All these are the lit exchanges versus one of the TRFs, one of the trade reporting facilities. This one's NASDAQ. For some reason, NYSE got cut off of this chart, but there is a NYSE TRF that was something like 7%. So what that showed was 40% of volume was executing off exchange, reported to the TRF. So every time Citadel internalizes a trade, it gets printed publicly. Every time Goldman Sachs or Morgan Stanley or JP Morgan execute a trade in their dark pool, it still gets printed publicly. You don't know who was the aggressor or anything like that, but you know the quantity and the price that it executed at. So now, if we go back quickly to ATS versus OTC, what I wanted to show was even though nothing has changed much in terms of where the trading is taking place, even a little less OTC, but that's probably just normal statistical noise. What has changed is who's trading on the OTC market. So in November, it was nearly all. I mean, it was not nearly all, but it was predominantly Citadel, with a little Virtu and an even little more G1X. And so this is market share. You can see that accounts for almost 85% of all OTC trading, and the rest is a bunch of smaller internalizers. And then it peaked for Citadel in January. But what we've seen since then is actually Citadel's market share in GME has dropped significantly. And Virtu has, and so has G1X. Virtu has really taken over. At the same time, the average trade size that's being executed OTC has plummeted. This was honestly really astonishing to me. I guess this is probably the Robin Hood effect or the retail effect. But you can see in December, the average trade size for Citadel was relatively high. It was around 350.
You don't think that's because there's no more shares on the market after we bought them all up in January? And so in order for them to fucking crush the price, they got to do it with a small amount of shares, but through a lot amount of trades? That's why Citadel had 1 billion trades over, or 1 billion shares traded on AMC, over 3 million trades? Like, I don't like what he's saying right now. It doesn't vibe well with my mind.
50 shares, and for Virtu, it was around 200.
A lower number of shares per trade doesn't mean lower trading, and the trading didn't go down nearly as much as he's making it seem like. Like, if the trading only goes down this much, but there's only 90% less shares available on the market, then that's a shit ton of trading for no shares on the fucking market.
And a little over 250 overall. And then
this
since
sounds
then,
like some FUD. This sounds like the very end, the FUD part to make you think Citadel's not the bad guy no more.
Anyway, I mean, these dropped to under like 40 shares average trade size. That was really shocking to me. Now, part of that has been the price increase. Absolutely. But at the same time, like an average trade size of 40 shares is extremely small. And so it's, I don't know what to make of it necessarily, but I thought it was an interesting sort of data point to highlight. I just wanted to show that. Yeah.
And so when you've got that Citadel has been decreasing on OTC since January, does that suggest that they're also increasing in off exchange?
No, so this is how much are they trading off exchange? This is just OTC, not ATS, not dark pool. But I don't think Citadel is a material part of the ATS trading in GME. I looked at it briefly and I saw it was a lot of it was interactive brokers. So when they internalize, they're printing on an ATS, not OTC. And they invite other firms to come into the ATS. That's one of the differences when you're trading or printing OTC versus on the ATS. Is other firms can trade in a dark pool, whereas OTC they're not.
Okay, that's interesting. And I think a lot of due diligence that we talks about dark pools actually suppressing retail buy pressure on the stock's price. What's your view on that?
How can this guy's brain be so slow? Like, it's almost there on everything, and he just can't fucking put it together. I don't understand. Is it intentional?
Yeah, I'm not sure of the mechanism for how that would work. Because, like I said, even if you're trading in a dark pool, that trade is printing to the tape. I think that if you can, I mean, technically you can't know that there are offers on the dark pool. That's why it's called dark. That's the whole thing. So if there's this wall of offers at 180, that would be, and you're sending, you're getting all these orders coming in on your retail channel, and you want to, keep it from going over 180 for whatever reason. I'm not sure of the mechanism that you would use to print that off exchange. I think, from that perspective, I'm sorry to say I didn't find that analysis to be compelling. I could be wrong, but I think, if you don't need the dark pools in that equation, you can layer orders in the market. you can,
That's what I'm saying. We already know the billion
you can
shares
internalize
with 3 million
it
trades
because
when
you're internalizing orders, you're
March. We
internalizing them
already
within
know
the
this.
NBBO, which you don't necessarily control. But if you want to
This
control,
guy's talking about old research that we've already debunked and proven what's happened on the OTC. It's not like we thought we couldn't read the price. We've seen how many shares they've traded and how many different trades. Like, this is
it,
stupid
you have to
talk,
do that
man.
on the lit market,
All right,
not
I'm
in the
done with
dark
it.
pool.
I'm done with it. I enjoyed it. I got what I needed out of it. He says he can see his name. Holy cow. Help me find it, people. God dang. Alright. Let me know if you guys see Punch Drunk. I mean, I know it wasn't Dave Lamoureux, but he'll probably come back bitching, and I don't actually hate him. I just don't want you guys to fucking get crazy when we're done being crazy. There's a time and place for everything. And if you aren't watching everything that I'm doing, don't come in here like a mod, like you know what's up if you haven't been watching the last 5 fucking videos. Oh, there's nothing that'll bother me more. I just don't see anything that says Punch Drunk. I didn't see it one time, I didn't see it 2 times, and I haven't seen it this time. Punch Drunk. Punch Drunk. Punch Drunk. Punch Drunk. If you guys didn't see it, I can't look no more times. This is the last time I can look. I don't like spending time looking at these things. Like, he can go start a new YouTube channel. If we don't find it and you guys don't tell me you saw it, exactly where you saw it, then I'm done. I can't keep trying. It's just not that important. Anyone can say, I got 4 different YouTube accounts right now. And I created new YouTube accounts so I could fucking super chat more money. Not so I could fucking talk on channels where I get fucking deleted. Like, ain't nobody need to fucking comment in my channel anyways. We got Plooch, but that's not Punch Drunk. No, I don't see it. I did not see it. Did anyone else see it? Alright, people. Everyone needs to come sign this petition. Show your support. We got 149 apes to sign up so far. We need this to say 3 million. Post it, share it everywhere you can. Let's go, people. Let's flacken go. The market is closed. AMC closed at 917. GME at 159.48. I expect the market to fall tomorrow. I can see GME going up a couple percent, or AMC, but I do not see a trampoline bounce happening at all. It does not appear to be a trampoline bounce right now. But I'll let you know if I see something different when I see it. Any final questions before I go? Should I stay or should I go? Where can you find the petition? Go to the description of this video. It's right there. Under the Mox Reports link, it says HTT change.it. Sign the petition. Holy moly. Alright, guys.